Good evening, everyone. On behalf of L&T Management, let me welcome you all for the media briefing of our financial results for Q3 FY20. As always, we will have a presentation on the financial performance of the company by L&T's whole-time director and CFO, Mr. R. Shankar Raman, followed by Q&A addressed by Mr. Raman and L&T CEO and MD, Mr. S.N. Subramanian. Now let me request Mr. Raman to begin his presentation.
Good evening, everybody. Thank you for being here this evening. Happy to report to you the Q3 results of the company with the usual disclaimer that any forward-looking statements need to be seen in the context of today's conversation, and it could change going forward. Before I get into the performance highlights, I think a few broad comments. The satisfactory results that we are going to share with you has been outcome of a lot of hard work by my colleagues in the company, and it's been a very challenging quarter. In fact, it has been a very challenging 9-month so far in the year, and so the results that are presented are to be seen in the context of the business climate in which we are required to deliver and create value. It is credible that the company has been able to muster its strengths and exploit its potential fully to be able to deal with what the economic challenges the company is up against. It's well known now and well commented and maybe even well accepted that the economic growth has slowed down considerably. We're talking about sub 5% as per the current assessment, and that's not really good news for companies like us, which depends on investment and investment momentum. But having said that, the good part of the situation is the opportunities have not disappeared. The prospect and the potential that the company is looking at continues to stay very encouraging. There have been deferments, there have been postponements of projects and programs, and the way we are looking at it is that these are opportunities deferred and not opportunities lost. Having said that, just a snapshot of how the company has fared in Q3 as of 31st December 2019. The order inflow as compared to the Q3 of the previous year is up by 2%, much against the market expectation where we were expected to report a decline. And to the credit again of our business leaders that we have been able to garner much of the targeted orders sans deferments. The order book consequently has grown by 9%. The revenue is up at 6%. You will recall at the half year level the revenue was up by 12%. It's at 6% for this quarter. EBITDA is up by 10%. That's good news because as we deal with softish revenue, we've dealt with more profitable revenues. So the margins are up by 10%, and the profit after tax is up by 15%. And these are quarterly numbers compared to the Q3 of the previous year. We've picked up orders worth 416 billion rupees against fairly stiff competition because opportunities being limited, competition tends to get tough. It's a 2% growth, as I mentioned, over the Q3 of the previous year. Out of the 416 billion rupees, 237 billion rupees comes from the domestic markets and 179 billion rupees comes from international market. The domestic market, as we can make out from the corresponding numbers of Q3 of the previous year, is down by 20% as compared to the reference period, whereas the international markets have yielded better results, and we've been able to establish a growth of nearly 70% by taking up the international orders to 179 billion rupees from 109 billion rupees. So there has been a bit of a compensating effect here, but this also plays true to the strategy of the company to straddle the opportunities both in the domestic market and international market so that we can balance them out appropriately without upsetting the overall growth momentum. As far as the 9-month is concerned, I think we are well in track. We had given a guidance of 10 to 12% order intake for the year FY20. At 9-month level, we are up 11% because we had a good start for the year. We were up almost 15% at the half year level. So even providing for the soft quarter 3, we are up 11%. And that gives us the confidence that we should be able to target and work towards a 10 to 12% order intake band that we had guided the market early this year. Statistically speaking, the domestic orders account for 850 billion rupees and international orders account for 436 billion rupees, and making a total of 1.2 trillion rupees of fresh orders for 9 months so far in the year. The mix of international orders is roughly around 34% to the total orders. When it comes to order book, we have a cross 3 lakh crore. We are at 3.06 trillion rupees, up by 9% as compared to 2.8 trillion of December 19 a year ago. The mix, thanks to the surge in international orders during the year, has gone better in favor of the international orders. So we have 24% of our order book from international markets and 76% from domestic markets, as compared to 21% in December 19. As I mentioned to you, while the mix between international and domestic have been fluctuating, it's very important to appreciate that the prospects that we are searching and working on to win our orders continue to be 5 or 6 times the numbers that we actually report as our win. So the win ratio continues to be around 15% of the orders that we pursue. For a 9-month period, bulk of the orders that we have won, which is 1.28 trillion rupees, comes from infrastructure sector. Virtually almost half of that is from infrastructure sector, and hence we keep laboring on this point that health of infrastructure investment, both in the country and outside of the country, is important for our group to get commissioned in all these projects. Hydrocarbon has been growing well over the last 6 or 8 quarters, and that is reflected by increasing share of hydrocarbon at about 15% for the 9-month period. Since for statistic reasons we include all the businesses that we run as a group, the services are also added here. The revenues of services actually translate into orders for services business, and they account for about 23%. The order book of 3 trillion rupees, 3.06 trillion rupees, actually has 2.2 trillion from infrastructure segments. This includes both domestic and international, and roughly about 73-74% of the total order book. Hydrocarbon at 464 billion has again a large share of orders to be executed, followed by power, which has 164 billion rupees. Early on this year, we won an EPC order for power, and we've been winning some orders for the FGD, flue gas desulfurizer projects. So the power order book has improved in the 9-month period to about 164 billion rupees. It is heartening to note that each of the sub-verticals, the major ones at least, are all blessed with 450, 460 billion dollars or billion rupees worth of orders. So that provides certainty about revenue visibility for the next 2.5 years. On the performance, the revenue of the group for the 9-month period ended 31st December 2019 is 1.01 trillion rupees, and for the quarter it's 362 billion rupees. The revenue is up by 10% for the 9-month period and 6% for the quarter, as we had seen earlier. 36% of the quarterly revenue and 34% of the 9-month revenue are on account of contracts that we execute internationally and the goods and services that we export. The manufacturing and operating costs declined by 3% for the quarter 3 at 218 billion rupees and up by 4% for the 9-month period at 606 billion rupees. The interest cost incurred by the financial services company is treated as an OPEX, and they account for 20 billion rupees in our quarterly charts, up 1%, and at 61 billion rupees, up 13% for the 9-month period. Staff cost is up 38% at 61 billion rupees for the quarter and 30% for the 9-month period at 168 billion rupees. It's important to note here that from the quarter 3, we have Mindtree staff cost getting added. So about 12 billion rupees of the 61 billion rupees is on account of Mindtree. And for the 9-month period, it's about 25 billion rupees. So if I exclude the Mindtree addition into this, the normal increase in staff cost of the rest of the L&T group is about 10%. The sales and administration cost of the group is at 21.4 billion rupees for the quarter 3, which is up 40%, and at 64 billion rupees, up 22%. The provisioning that we have made for the financial services business, as well as the expenditure that we have incurred on acquisition, have all contributed to the rise in this period under question. The total operating expenditure up 10% in the 9-month period and 5% for the 3-month period. Consequently, the EBITDA at 41 billion rupees for the 3-month period and 112 billion rupees for the 9-month period is up 10% and 12% respectively. And this is where I find the comment of margin increase getting expressed from 11% to 11.4% for the quarter, and from 10.9% to 11.1% for the 9-month period. You will recall in the earlier commentaries that we've had that we liquidated our temporary surplus investments to be able to finance the acquisition of Mindtree. So consequently, the treasury balances that we have at hand to be invested in the market is far lower in quarter 3 as compared to the previous year. So we find there is a decline in other income at 4.7 billion rupees for the quarter 3, and at 17.1 billion rupees for the 9-month, shows a contrary direction, largely because of the gains that we have booked when we liquidated the investment for the purpose of acquisition. Interest cost at 7.1 billion rupees for quarter 3 and 19.8 billion rupees for the 9-month period show an increase of 33% and 53%. It is to be borne in mind that as we have increased the borrowing during the course of the 9-month, year to year, it's almost 13,000 crores. The interest cost on account of that additional borrowing is embedded in the increase in the interest cost, as well as the fact that Hyderabad Metro has been commissioned substantially, about 10 kilometers short of the overall stretch of 66 kilometers has been commissioned. And as we commission the project, the capitalization comes to an end and the interest cost gets charged to the P&L. So there is an element of interest cost increase of Hyderabad Metro as well. Plus the new accounting standards on leases compels us to segregate the lease rental income into principal returned as well as interest paid. So the principal return gets, the interest paid gets added to the interest cost as well. So in a way, it's not a very straightforward comparison of two periods. It's a combination of several moving parts insofar as fund management is concerned. Depreciation, amortization at 6.6 billion rupees for quarter 3 and 17.5 billion rupees for 9-month period show an increase. Here again, I think the accounting standards on lease accounting plays a role, plus the fact that we are now integrating Mindtree charts into our charts. So there is an increase on account of depreciation of that acquisition as well. Exceptional income, we have nothing in the current year. So there is no impact on the financials of the company. The discontinued operations are the electrical business that we have held for sale, and the process is underway. And the business, however, has done well, and according to the accounting conventions, we only report the net results of the business, electrical business. The quarterly profits are 1.9 billion rupees, up 36% as compared to Q3 of the previous year, and at 5.2 billion, up 41% as compared to 9-month period. The profit after tax, considering all of this for the quarter 3, is at 23.5 billion rupees, up 15%, and for the 9-month period at 63 billion rupees is up 16%. The segments that we are engaged in, which has generated these returns, is what we will go into at the moment. The infrastructure segment, the revenues have degrown by 5.3%. And here I must mention that while the order intake of the infrastructure segment for quarter 3 has moved up by 28%, there have been considerable challenges on execution front, particularly in this quarter. It's well publicized once again that change of governments have led to stoppages of work. We've had public interest litigations which came in the way of project execution, and above all we had pollution factors which prevented construction sites to work. A combination of all of these things upset our revenue growth plans, and the good part of this is I think most of these are hopefully getting behind us, and we will find us getting back to more acceptable trajectory going forward in the subsequent quarters. But be that as it may, the quarter 3 does show a revenue decline for infrastructure segment at 5%. However, for the 9-month period, since we had relatively uninterrupted situation in the first 6 months of the year, we are grown infrastructure segment revenue by 4.7% at 477 billion rupees. The EBITDA margin of the segment has improved well. Even though the revenues had declined for quarter 3, the margins have moved up by 70 basis points. This is largely representing the stage of execution of the infrastructure projects that are coming up for valuation. The EBITDA margin for the 9-month period at 6.5% is up 30 basis points as compared to the 9-month period of the previous year. Power segment continues to have mixed fortune. We've had a good start to the year, won some EPC contracts. We continue to win some FGD contracts, but large EPC contracts are elusive because of the deferment of those projects. So consequently, the opening order book, which was very soft because of the lack of orders in the previous year, continued to have impact on the revenue of the current year, and the revenue declined by 23.4% in quarter 3 and 42% in 9-month period. Now, this trajectory can be reversed only when we build our order book through fresh order wins. Otherwise, as we execute the projects that we are bagged, the revenues will only tend to come down going forward. But we do believe that with some order wins in the current year and hopefully some more along the way, we should be able to get the revenue into more healthier levels. The EBITDA margin of this segment is about 3.4% for the quarter 3 and 3.6% for the 9-month period. It's important to recall here that the manufacturing joint ventures that we have, being jointly controlled with our partners, are not consolidated at EBITDA level, they are consolidated at PAT level. So the EBITDA margins of the manufacturing activities are far healthier than the pure EPC, which is at 3.4 and 3.6% respectively. Heavy engineering segment had a good run in the previous year in terms of order intake. So consequently, they are having a good run this year in terms of revenue. The quarterly revenue at 7.2 billion rupees is up 19.6%, and at 22 billion rupees is up 57% as compared to the previous year. Much of this business is international, as you can make out that out of the 7.2 billion rupees, 4.1 billion rupees is from international orders. And likewise, nearly 50% of the 9-month revenue is also from international orders. The margins in these businesses are good as we complete the jobs and deliver to the customers' requirements. The margins for the quarter is at 23.5%, and for the 9-month period is 22.3%. The margins again is a mix of the delivery schedule and the stage of execution. So consequently, while the quarter to quarter trajectories could be misleading, it's important to understand that this is one of the superior margin business, for the simple reason that the technological differentiation and the track record that we have with international customers is far superior to the nearest competition that we have from India. Defense engineering segment, the revenue has grown by 5.8%. These are arising out of execution of the order book that we already have, thanks to the order wins of the previous year. And for the 9-month period, the revenues are 30 billion rupees, up by 14.4%. Much of this revenue is domestic, as we can make out from the nature of the orders that we have received. And the EBITDA margins, like the heavy engineering, is pretty healthy at 20.5% for quarter 3 and 18.4% for the 9-month period. Hydrocarbon segment continues to do well. For the last 8 quarters, the business has been reporting quarter-on-quarter improvement in terms of operational parameters, execution capabilities, as well as ability to win orders. The segment revenue for quarter 3 at 43.9 billion rupees is up 16.6%, and for 9 months at 124 billion rupees is up 15%. Much of the revenues come from international business. Nearly 45 to 50% of the orders that we win are in the international markets. So the international revenues continue to be a fairly significant percentage of the total revenue. The EBITDA margins have been improving as the execution efficiencies have improved, as we adopt more and more into digital technologies for productivity and enhancement, as well as smartening the procurement and engineering processes. We are able to get ahead of the budgeted levels for margins. We are at 12.1% at quarter 3 level and at 10.9% at the 9-month level. The sustainability of these margins, we do believe, is there. Of course, it all subject to the execution track record that we have on the order book, and it is project to project. It's living life project to project. The current set of projects are well administered and well delivered. Information technology and technology services, you would have had an opportunity to see all the results. All the 3 companies, L&T, Infotech, Technology Services, as well as Mindtree, have announced their results, and you would have seen that all of them have reported encouraging numbers. The consolidated segment revenue for this segment is 60 billion rupees for quarter 3 and 157 billion rupees for 9-month period, showing an increase of 64% for quarter 3 and 48% for 9-month period. The percentages are inflated largely because the previous year's numbers exclude Mindtree and the current year numbers includes Mindtree. But suffice to know that on an aggregated basis, the revenue growth year on year for each of these companies are in the ballpark range of 10 to 12%. Much of this business is international, as you know, and the EBITDA margins at 21% for quarter 3 and the same percent for the 9-month period does show a decline as compared to the position previous year, largely because of 2 reasons. One is, I think, the staffing costs and the resourcing costs have been going up steadily as we increase the international content of our workforce. And secondly, when we integrate Mindtree, the profitability of Mindtree are not in par with the LTI as well as L&T Technology Services. So until they improve, for which we have a roadmap, there's going to be a blended decline in the margins reported. We do think that in the next 2 to 3 quarters, this position should dramatically change. Financial services segment, once again, I have reported their revenues a few days ago. The revenue for the quarter 3 is at 35 billion rupees, up 8.9%. This is despite a 20% decline in the disbursement. The business, for very obvious reasons, have got fairly conservative when it comes to disbursement decisions and credit calls. The environment does not support aggressive lending. So consequently, the revenue growth, which used to be in double digits, have come into single digits. But I think it's a tactic par for the course, considering the current conditions. For the 9-month period at 104 billion rupees, it is just about meeting the double digit at 10.6%. And the profit after tax belonging to L&T, net of the minority interest holders, is at 3.8 billion rupees for quarter and 8.4 billion rupees for the 9-month period. You see the decline in the profitability largely because of the provisioning that is required to be made for the non-performing asset. The net non-performing asset of the business is about 2.7%, with considerable provisioning having been made for the assets which are worthy of those provisioning. Getting on to developmental projects, it's a combination of the Nabha Power thermal plant that we run in Punjab and Hyderabad Metro. The revenues are largely from the thermal power plant business because Hyderabad Metro is yet to contribute significantly to the revenue asset. 12.4 billion rupees for quarter 3, the revenue is up 3.7%, and at 38.7 billion rupees for 9-month, revenue is down by 2.9%. The margins at 17.3% for quarter 3 and 12.4% for the 9-month are reflective of the margins that the power business and the Hyderabad Metro business has, because in all these sessions, as you know, EBITDA margins are high. It is the interest depreciation that actually trends the P down. In other segment, which consists of our construction mining equipment business, rubber processing machines, valves, as well as reality, the revenue at 12.5 billion rupees is down 22%, largely on account of the lumpy commercial property sale that we did in the previous year, quarter 3, out of the realty business portfolio. And for the 9-month period at 39.4 billion rupees is again down 10.2%, largely because of the same reason. The EBITDA margins at 21.9% for the quarter 3 and 22.5% for the 9-month period continues to be healthy, although reflecting a decline, which is largely on account of the the slowdown in industrial demand, as well as the softness that we see in the real estate sector. Electrical and automation segment, the final segment which we are holding it for sale, has shown a decline in revenue at Q3 at 13.3 billion rupees and a marginal decline of 1.1% for the 9-month period at 41 billion rupees. It's important to note that the industry has declined by a much larger percentage, reflecting the slowdown all around, and the fact that our business has declined lesser means that our market share in the relatively challenging conditions have improved. The EBITDA margins of the business continues to be very healthy at 19.3% for Q3 and 18.1% for the 9-month period, validating the several initiatives the business has taken to make the business more profitable. So with this, we conclude the presentation and happy to take questions and answers. Thank you.
Hi guys, good evening.